my name is Natalie Westfall, Vice President of Henry Schein Financial Services. On behalf of our entire team, thank you for tuning in to our year-end tax planning webinar. You will get a lot of valuable information tonight, but just a reminder that this is not eligible for CE. Henry Schein has always been a trusted source of valuable information for our customers, but even more so as we have faced the challenging 2020 together. I'm joined today by Bob Gray, CPA. Bob is a member of Gray Pilgrim and Associates, LLC, and a founding member of the Academy of Dental CPAs. Bob will spend time today discussing the 2020 tax laws, including Section 179, depreciation, CARES Act funding, and potential tax implications, and other factors you should consider as year-end approaches. We will conclude the session with live Q&A. If you have any questions you would like Bob to cover, please type them into the chat window, and we will get to as many of them as possible. I will now turn it over to Bob to kick it off. Hi, Bob.
Hi. Thank you, Natalie. So let me start out by saying, gosh, 2020, what a year, huh? I hope we're all COVID-free and your practices are all back to some semblance of normal, whatever that means in 2020. But what I want to go through tonight is it's been such a challenging year in many ways, but this is even the most unique tax year, I think, ever in terms of the planning and the different things you're going to have to do between now and year end. So I want to go over some of those topics tonight. We're going to cover a smattering of a whole lot of different topics, but feel free to type in questions. We're going to try to leave some time at the end to dig into many of those as we possibly can. As Natalie said, I am, hang on one second, a little technical. There we go. I'm actually doing this for Henry Schein, and so it's a situation where Henry Schein is not offering tax advice, although I am, but this is not on Henry Schein tonight. So I am a member of the Academy of Dental CPAs, one of the founding members, in fact. I've also done the business of dentistry courses in the Caribbean and in Hawaii for the Academy of Dental CPAs, instructor for the Dental Business Institute in Milwaukee, and I've lectured to dental societies. So I've spent my entire career working with dentists. I'm also, my wife and I both love Napa and chasing those 100-point wines, so we're both crazy about that. And this is a crazy 900 horsepower Cadillac that I had modified, so I do have some little vices as well. I don't know if all of you have ever heard of the ADCPA. It's a group all across the United States of accounting firms who are dedicated to helping dentists. You can see if you go to adcpa.org, you can find a dentist. You can find a location near you of one of the CPA firms that are members of that. You know, people ask me all the time, what's really the difference between a specialist? But, you know, if a CPA is a general practitioner, they might be dealing with a car dealership one day and then a bank and then the dentist. You know, with the Academy of Dental CPAs, we're only dealing with dentists all day long. And it makes a big difference. When you have questions about your dental practice, your taxes, it helps. And I always say, if your current accountant can't point to tooth number 8, you know, pick one who can. Tonight, we're going to be talking about initially these tax planning considerations. That's one of the biggest things and the most challenging thing for the end of this year. Many of you, and most of you, probably got those PPP loans. And so the question is going to be, how will that affect my tax planning this year? What if it's forgiven, what will happen, and how will that affect me? And also, you've all heard of the QBI deduction, qualified business income. We'll talk more about that a little bit later, but that's going to have an enormous effect on the QBI deduction depending on the size of your loan. And this year, again, if you could elect to modify your taxable income and have it go up or down almost at will, depending on which way you choose, could this be a year to even convert some, you know, standard IRAs into Roth IRAs? For some people, it could almost be a zero tax event if it's low enough. So that could make a big difference. And how about the election? Gosh, there's another big factor. You know, if Biden wins, he's promised to raise the tax brackets. And so it's difficult to know, well, which year will I want income? So, you know, stay tuned. We're all going to find out on November the 3rd. But also then, should I elect Section 179 for my purchases this year? And again, a lot of it's going to depend on the things we're talking about up and coming here. But those are just, keep all of those issues in mind as things you're going to be thinking about before the end of this year and before you file returns. Let me start out by saying, though, that IRS issued Notice 2020-32. This notice essentially in English says, hey, if you got a PPP loan, that money is tax-free. We're not going to dispute that. But the problem is that the expenses that were used to get that forgiveness are therefore not tax deductible, which is ridiculous because it makes it the exact same thing as being taxable. You wind up losing, if you had a $100,000 PPP loan, you wind up losing $100,000 in deductions. So it's the same thing, really. It's important to note, though, that ever since the IRS issued that, Congress has been going back and saying, hey, that really wasn't our intent. That's not what we meant. We meant for it to be truly tax-free. We'll see if Congress can actually, make some progress to enacting something here before they actually go to recess. So we'll see what Nancy Pelosi and the rest of them can do with this. But just keep this in mind that it's possible, if all the things we're talking about tonight, if Congress acts before the end of the year and enacts that rule, and the PPP loans do come truly tax-free, it's obviously going to have a big swing in what we might talk about. So just keep that in mind. We talked about the qualified business income deduction. I want to remind you that it's a 20% deduction for earned business income. It does not, however, qualify for any money earned on a W-2. So if I'm a sole proprietor and I file a 1040 with a Schedule C, all of that income could be subject to that QBI. If I'm a partnership and I get a K-1 on my partner, the income that is on my K-1 subject to self-employment income is eligible for this, not guaranteed payments. If you're an S corporation, your K-1 dividends are subject to this 20% deduction, not your W-2. So think about it if you're an S corporation, and let's just say you had $300,000 of total income for the year. If you took $290,000 as a W-2, you're only going to have $10,000 eligible for the QBI deduction at 20% or a $2,000 deduction. If you took $200,000 salary and had $100,000 that flowed through as a K-1, now you'd be eligible for a $20,000 QBI deduction. So it's really important to balance those W-2 wages and the K-1. I mean, you have to take what's considered a reasonable salary. And that's the S Corp rules. But in this given year, reasonable might be subject to a lot of different interpretations. So I would say, just again, make sure that you've managed your W-2 income so as to balance it and create the highest reasonable K-1 source of income to qualify for that QBI. And again, this PPP loan could have an enormous impact on that. Let me show you an example. So here's a person that got a $150,000 PPP loan. And let me say that the 2020 income limits for the phase out of the QBI are up above there. Joint taxpayers, it starts at $326,600, where you would start to lose some of the QBI, and it ends at $426,000. So by the time you have $427,000 of income from a dental practice, you do not qualify for the QBI. And that is total family joint taxable income. So on a joint return. And single, as below, you can see below, $163,000, it begins, ends at $1,213,300. So those are the limits where it phases out. Anything below that, you're eligible technically for 100% of the QBI deduction. But look at that column in the middle. If the practice had a $320,000 net income, and with your itemized deductions and your adjustments, you have another $30,000 in write-offs. And now, because of that practice net income, you have a $64,000 QBI. If this was a sole proprietor or LLC taxed as a partnership, your federal tax would be $42,399. But look what happens if I had a $150,000 PPP loan that was forgiven this year, and it turns out to be taxable income. Now I lose the QBI deduction. You can see in that right-hand column. Suddenly, I got $470,000 of taxable income. I'm over the limit. I'm now pushed up to $103,000 in federal taxes. That's a $61,191 increase, or 41% of the PPP loan. Remember that the highest tax bracket is only 37%. So it's the loss of the deduction and creating the tax that could really push you out out into a limit that you didn't want to be. No one wants to be in the 41% tax bracket if they can avoid it. So I would encourage everyone to try to make sure, you can see now maybe how important balancing the K1 would be on an S Corp, but also looking at how will this affect my QBI deduction this year. It's going to take a lot of tax planning before year end in order to make sure you've got all your options available to you. So keep in mind that this is probably one of the most important topics I think we're going to cover tonight. I also want to go into purchasing dental equipment. I mean, a lot of clients have come to me and said, well, Bob, this is a great year for me to expand. I had some downtime. I did some remodeling. We've done some things like that. And I want to talk about exactly what the effect is, because I think a lot of times people forget. Let me start with the Section 179 deduction, though. Section 179 is that section of the IRS code that says you could rapidly and immediately deduct, rapidly depreciate or immediately deduct any purchase. In this particular year, those are up to $1,040,000 that you could take as a one-time tax deduction if you bought that much equipment. But the spending cap is $2,590,000. So, and again, you could only spend up to that point in order to be eligible for the Section 179. Luckily for 90% of people, they're not buying millions of dollars of equipment every year, but that is the cap for larger companies. And it does work on new or used equipment. And it must be placed in service before 1/1/21 of the new year. I point out that it's not deductible in every state for state tax purposes. It is for federal purposes. Let me go back to that placed in service rule, though. The IRS says you can't just write a check and say on December 31st that I now bought new equipment, and then it arrived sometime in 2021 and was later plugged in. The rule is that it has to be in place, plugged in, and available for use. And so make sure that when you're doing these decisions for year-end purchasing, to try to do it quickly, because there could be lead times that you're going to have on shipping for equipment and dealing with those timing issues. Again, remember, it needs to be unboxed in place. It doesn't have to actually be used. It has to be available for use. So on midnight on December 31st, make sure everything is all plugged in, okay? So let me just show you an example here. This is just a real simple example, but I think people forget about the 2-year tax effect that this has on buying equipment. Let's say I bought equipment on November the 1st here, and I know many of the lenders have some tremendous programs going on now for interest rates and things. I know that Henry Schein Financial has an opportunity for 6 months of no payments and 3.99% fixed. So at this point, let me show you, though, that if I signed that order today, I got the equipment, I signed a promissory note now in November of 2020. If, in fact, there's no payments through April, fast forward ahead to April 30th of 2020. I've made no loan payments yet whatsoever. But at a 30% tax bracket on $150,000, I already saved $45,000 in taxes on my 2020 return. But what people forget, though, is that your taxes this year, being 2021, then fast forward, are also a product of what potentially you paid in the year before. But look at the cash flow. Again, because I may have saved taxes in 2021 on my initial estimates, I'm already $55,000 up. In other words, I've made no payments on the equipment, on the purchase whatsoever, but I have $55,000 more than I had the day before I signed this order. That's a pretty tremendous ROI. I mean, a zero investment and $55,000 back. And again, when you're adopting new technology, you're doing things that might have a learning curve or training period. These tax savings are huge in helping cash flow and overcoming the concern about some of these, some new technology potentially. So just realize that it is a 2-year effect. When you're doing your estimated taxes, the IRS says that you can actually pay 110% if your AGI is over 150 of the year before. That's the only thing you're required to pay. So if we had a huge tax deduction for 2020 and it brought your income way down, you're only required to pay 110%, depending on your AGI, of this year's taxes during 2021. So again, lowering your taxes this year does have a cash flow effect on next year. It doesn't actually lower the taxes that are going to be due for 2021, but it does lower the requirement to actually make payments, which again is huge, because I think if you can lower your tax liability by $45,000 this year, and that's example, even if you're at the 110% bracket, it saves you another $40,500 in cash flow for the whole year next year. And so if I said to any one of you, hey, do me a favor, here, you can have $40,500 completely interest-free, and all you have to do is pay me back on April 15th of 2022. Who wouldn't do that? And so I think at the end of the day, you can see that it's not just the tax savings in the year that you buy the equipment, it's that follow-up cash flow effect that you have. Now, again, you do have to pony up on April 15th of 2022, but again, tax-free loans are some wonderful sources of cash flow, right? And these things do apply to all entities. I've heard people say, well, Section 179 doesn't help because I'm a C Corp or whatever. But, it does require a little extra planning with a C Corp, because you've got to adjust your salary and make plans to make certain that you actually, enjoy the benefits of that tax deduction and not just have it throw into the C Corporation. And if you're an S Corporation and you've already taken too much salary so far this year, it's difficult to back up. And so it does require a little bit of extra planning. But again, it really does apply to every entity. So if you talk to your tax advisor about how this could work for you, I'm certain you can find out, which steps you have to take. There's other tax considerations when you're talking about expanding your practice. And I want to talk a little bit about cost segregation studies and the abandonment of leasehold improvements. Because I think a lot of people forget that can be a really big tax deduction when it comes time to make a move. A lot of people overlook that. And I think when you're trying to make expansion plans or do something else, you certainly have to take all of the tax considerations into effect to make sure that you're taking the benefit of all of it. Whoops. All right. Not sure what that did. All right, so apologize for a little technical errors. The computers are great when they work. So let me talk a little bit about the deducting of the balance of an unamortized leasehold improvement. So the IRS says that the loss of abandonment of business or investment property is a deductible loss. And so when let's just say in this example, you made a $300,000 of leasehold improvements way back in 2010 to your rented office space. You've been amortizing them over 39 years because you did not do a cost segregation study. We're going to talk about that. And now you decide to relocate your office. When you leave the old office, there's approximately $215,000 of unamortized leasehold improvements that are, quote, left behind. And the day that they are abandoned, the day that you walk away from that lease, is the day when that's tax deductible. Now that can be, a really big tax deduction in terms of the whole cash flow related to this expansion or relocation or whatever it is. So make certain that if you've done leasehold improvements to your current space and you're considering relocating, that you make certain you take advantage of that. That's going to be a really big factor. The other thing is the cost segregation study. I call it how to turn studs and drywall into Section 179 eligible expenses. It's funny, very few people, when I talk to them, have heard of a cost segregation study. Many, many years ago, the IRS lost a court case with the Hospital Corporation of America. Let me back up. If you build a building or you do whatever, the IRS says you have to basically, for commercial buildings, depreciate them over 39 years. But if you look around in a commercial building, the carpeting won't be there 39 years from now, most likely. Ceiling tiles, paint, wallpaper, whatever. There's a lot of things that won't be there 39 years later. And so the Hospital Corporation of America argued that, hey, that's just not accurate. We want to be able to depreciate the things over their real useful life. And they challenged the IRS and they won. But what the IRS did then was brought up a whole series of really technical procedures that you have to follow in order to take this benefit. Otherwise, you're stuck just keeping it at 39 years. Let me give you an example. Let's say you had $1 million building. Eventually, in a 40% state and federal tax bracket total, you would save $400,000, right? But without a cost segregation study, you're basically taking about $25,000 tax deduction per year for 40 years. That's $10,000 a year over 40 years. I mean, many people build buildings and aren't practicing 40 years after they moved in their new building. So that doesn't really give you that great of a tax benefit. If you do a cost segregation study and break the building down into its components, many times a minimum of 20% of the cost of the building winds up as a 5-year asset, which is basically like dental equipment. A little bit in 7 years, some in 15, and the rest goes into 39. But in this example, look at that. There would have been $80,000 in additional tax savings in that first 5-year period because of this cost segregation study. And when did you need the deduction the most? It's obviously when you have that big brand new mortgage and a big lump in your throat, right? So this is the time you want to be able to do it. These analyses, a lot of companies will do these things for free where you can see exactly what the benefit will be and you can follow through. There's a lot of numbers up here, but let me just tell you that I only use this to say, this is if you owned $1 million building in this particular example. The next one was someone who did 500,000 in tenant improvements. So you do not need to build a new building in order to make this be something you're interested in. You only have to have made significant improvements that you paid for. That's really the key. Again, if you remember nothing else, just remember that if you do a cost segregation study, you can see in that little green box there, you can break the building into pieces. In the yellow box without, you're stuck with 39 years. But let me just give you a quick example. So I ask, what's this? Now the real answer is, I don't know, because I have to know what's plugged into it in order to know what that is. So if I plug a fax machine into that, it becomes a fax machine. But it's not just the outlet, it's all the wiring and all the thing that's going to go back to the breaker, part of the actual building permit costs and everything that went into that. That could be a $300 or $400 item. And when you turn it into a fax machine, it's no longer a building for 39-year depreciation. It could be something like 5 or 7 years and subject to Section 179 immediate tax deduction. And that is the part that's huge, turning a building into something that could be immediately deductible. Another quick example, is this a building or equipment? Is this something you'd have to depreciate? That's a light sconce on a wall if you can't see, because it's considered decorative and not functional. It is actually something that would be equipment that could be deducted immediately. But let me tell you that in a dental practice, my gosh, all the electrical, all the plumbing, all this infrastructure and all the things become dental equipment, not a building. And so that's what makes it such an enormous tax deduction and an opportunity when you do these cost segregation studies. So, the load-bearing walls do not qualify. Part of the superstructure does not qualify, and land never qualifies. So those are the two things that really won't qualify for any rapid depreciation. But just remember that, again, if you've done any significant improvements this year, you're going to want to consider the possibility of doing a cost segregation study. There's another really big factor of these cost seg studies, and that's, I think, the timing. Let's say you did a practice expansion and you bought a lot of equipment. Maybe you say, well, Bob, I've got enough tax deductions this year just in the equipment alone. I don't really want to do a cost segregation study. It doesn't really help to get my taxable income down that low. Because if you already have enough deductions, remember, if you look at the tax bracket lists on the left there, you'll see that taxes start out at 10%, up to $9,800 for single and $19,750 for married, filing joint. I mean, I would argue the taxes are on sale when it's at 12%. And so if you say, well, I was clever enough to get down to the point where I paid no taxes at all this year, not really sure that was a good thing, right? Because you're basically using some of those deductions in a 12% tax bracket. That may or may not be a really good thing for you to do, especially if the practice is going to rebound and you're going to have higher taxable income in the future. You really have to make sure that you don't overdo these deductions. The beauty of this means that for Section 179, if you bought one piece of equipment worth $100,000, you still are not stuck with making one decision for that. It's not an all or none. You could only elect to say, I just want to take 10,000 of that and make it a 179 election. I want the rest of it to be spread out over time, because maybe, again, that was a better tax planning move for this year for these taxes. Again, you'll have to decide. But the really good thing about timing the cost segregation study is, again, if you had that year where you bought a lot of equipment, you moved to a new building, now you could actually purposely postpone doing your cost segregation study. Because if you do, when you do the cost segregation study and when you file the forms to go back and correct this depreciation, you can do it all in the year that you actually make the correction. So think about it. I could be 3 years into this new building project, 2 years, whichever, and I've already taken all my Section 179 on the equipment. And now I do this cost segregation study in order to be able to pick up another whopping big chunk of tax deductions, because I'm allowed to pick up all the depreciation that could have been taken for that whole period. So if it's 3 years, it could be all the accelerated depreciation for the whole 3-year period that now winds up on your tax return on year 3. And again, maybe that's because the practice is ramped up and you're really going great guns in this new building. That's a great time to get a big tax deduction, obviously, when the taxable income is higher. So I just want you to realize you don't have to do the cost segregation study exactly in the year that that new building was built or those leasehold improvements were finalized. You know, the interest rates are so incredibly low these days. I think a lot of people forget about the benefits of looking at refinancing. We've had a number of people that have taken advantage of these super low interest rates. This is really just a quick example, but let's just say you had a dentist that had 2 different loans. Maybe I had my initial practice loan for startup that I'm down to 300,000 for, and then I bought some extra equipment. 3 years later, that has a balance of about 100,000 on that loan, and I'm paying $6,200 a month in bank payments on these 2 debts. Simple example: if I just refinance this at 3.99%. I dropped my monthly payments by $735. And I would tell you that it's just a great time. Too many people get sort of buried in like, well, I've got my loans on automatic pay. I don't really think about it. But again, these are record low interest rates that we're dealing with now. So please make sure that you're looking into the opportunity to take advantage of that. Let me
Bob, we actually just have a question about that. If you could go back one quick slide.
Sure.
One of our attendees is asking, what if you have been in the building since 2005? Can you still use cost segregation savings now?
Potentially, but I would tell you that the vast majority of the benefit is probably gone, but that's going to be something that's very specific to how big the project was, how much depreciation was already taken. You'd have to look at your own individual cases, but I would just say never say never. I mean, there's never a time when because these examples that I showed earlier, the cost savings, many of those, again, do those things for free. Many of the companies that specialize in cost segregation analyses. And so it's really no cost for you to find out exactly what the benefit would be. I mean, certainly the sweet spot is in that 3 to 5 year window, but almost anything beyond that is still possible, depending on the size of the project.
Thank you.
Sure. Let me just completely swap topics and talk about the HHS. I know we're bouncing around, but these are all 2020 issues, and gosh, what a year it's been, right? The HHS grant started with what they were calling phase 1, was just to Medicaid providers. That was the only people eligible in the very first wave of money that came out. Phase 2, they brought out the 2% of your prior year's gross income as a grant. And a lot of people were confused by that because they thought they still had to be a Medicaid provider in order to be eligible for that. You did not. You only had to have a 2019 or 18 tax return you could upload to the HHS website and apply for the 2% grant. So if I collected $1 million the year before, I get a $20,000 grant now. And again, it is truly a grant. It is taxable income, but it is not a loan that ever has to be repaid. So that was considered free money. When phase 3 came around, the HHS still had $20 billion of money left to spend that Congress had approved originally. And they went back and said, well, gosh, let's just make sure that everybody who is eligible for phase 2 really did apply. And let's see if we can now distribute the rest of this money based on what they're going to call need. And need, when you look at the phase 3 applications, you basically say, well, this is my income in the first 2 quarters of 2019, and this is my gross income in the first 2 quarters of 2020. This is my overhead before, and this is my overhead after. And they're looking at the financial damage that basically is done to the practice by comparing those two things. And then they're going to award money when they're going to pool everyone after that and pool and distribute the money based on the financial need that you had as a percentage of the whole. So there's no way to really guess exactly how big these grants could be. Most people are guessing it's not going to be anywhere near as big as the first grant. But again, you're really not sure unless you know how much damage you've done or have had to your practice compared to every other practice on the planet. So it's going to be difficult. But again, this is a grant. It is taxable income, but it is free money. And so I would encourage everybody to try to take the opportunity to take a look at that. If you go to the hhs.gov website, you'll see under the coronavirus tab that there is a thing that says how to apply for the phase 3 general distribution. If you click on that, it will take you directly to the instructions on how to file for that. The deadline is November the 5th. And so I would encourage everybody to go sooner rather than later. You want to make sure that your name is at least in the pool for the opportunity to take advantage of these grants. There's a couple other SBA loan provisions this year. There was the economic injury disaster loans, or the IDEL, and the payroll protection loans. And I think there's been some confusion about that, and for many taxpayers as well. The IDEL loans are obviously something you're going to repay with interest over at 2.7 or 3.75% over a period of years. That is definitely a loan. It's not a grant. It's not taxable income. The payroll protection loan that you got, however, we're going to talk a bit about here because that has the potential, like I said, depending which way Congress goes, to have a big effect on tax planning for this year. So I also want to talk about the uses of this IDEL loan. This has come up quite often. Realize that the rules are that the IDEL loan proceeds had to only be used to basically recover. It was only intended to help working capital and pay for expenses that otherwise weren't being paid for by revenue from patients. And so you cannot use it to just give yourself a bonus of extra money. You can't use it to refinance any existing debt. You can't use it to expand or buy a new building or do any big assets. You can certainly use it to buy oral evacuators or things like that were part of a recovery, but you couldn't say, oh, I'm going to add a new wing on the building or equip 2 new operatories now that I have the access to this money. That's not what it was intended for. And so that's, again, make sure you're using it properly for things that are strictly overhead related.
Bob, I have a question about the IDEL $10,000 IDEL payment.
Yes.
And whether or not that was a grant.
That was a grant. We're going to come up and talk about that in a minute. However,
Okay,
we'll find out that a grant is not exactly a grant. So we'll talk about that in just a minute.
Sure.
So let me switch now to the PPP loans. Okay, qualifying for forgiveness now is with the hot topic. What do I have to do to get this loan forgiven? What are the processes? What do I have to deal with here? For most of you, if you had a loan that was outstanding before June 5th, you're allowed to elect an 8-week period for that forgiveness. But I can't imagine very many people would want to unless there was a reason, like maybe if the practice was sold in early July and you already had used the money, you wanted to qualify for the 8-week period there. There may be a few examples when that would be appropriate, but for the vast majority of you, I think you're going to find that the 24-week period is actually the easiest way to qualify for this forgiveness. The reason is that you only were eligible for about 10 weeks of payroll, right? I mean, 2.5 months was your times payroll, about 10 weeks. But now you had 24 weeks in which to spend it. And so it's going to make a very big difference in how easy it is to qualify for that. But either way, you had to use it at least 60% for salaries and wages, and the other 40% can be used for those non-payroll costs, which are rent and utilities, mortgage interest if you own the building. The other thing is that you also have to promise that you kept a full-time equivalent at employee levels before and after. So if you look at the period before the loan and you look at the period after, you're basically, and this is a big overview, you're saying you've rehired all the people or brought it back to full-time levels that you did. If you could not reduce any one person's pay by more than 25%, and you had to bring your FTE equivalents back up. So if you failed to do that, only a portion of the PPP loan would be forgiven, not the whole thing. We're going to talk about a couple things here in this full-time equivalent, though. There is a couple exceptions. So one of the exceptions to the 25% reduction is that if the pay cut occurs before the 26th of April, but then you restore it by the 31st of December this year, you automatically qualify. So it could be reduced for all that period of time as long as you get it back. And obviously that means you've also elected to apply for this loan forgiveness after the 31st of December or after some time period when you did restore that pay. The full-time employee equivalent reduction also has two safe harbors. If it also occurred before April 26th, but then restored, even though you were down throughout the summer, it qualifies. And also they have a really broad extent. This is if my business was reduced because of COVID-19. Well, I'm not sure how many people won't be able to say it was reduced to some extent because of COVID-19. We've certainly had some practices that are back and busier than ever, but I'm not sure overall it's going to be possible for many people to recover, from what they had in 2019 when you had several months off if your office was closed. The other exceptions, however, to this requirement to bring back your full-time equivalent is if someone just refused to come back the same number of hours, or they were fired for good cause, they resigned, they requested to reduce their hours, or the one that's unfortunately popular was they refused to come back to work because I was making more money on unemployment for a while there than I was if I would come back to work. So any one of those things would still make you eligible to say I actually am back at full-time equivalent of where I was before the loan was issued. Now, again, it's going to really be important to document these things. It's easy if I don't have to qualify for an exception. I have payroll records and they have the number of head counts and all those sort of things. But if I don't, well, I'm going to need all the resignation letters. I'm going to need all the documentation that talks about why I still qualify. So we'll talk about that more in a little minute. Again, I want to point out that the 24-week period is way easier to deal with because you only have 10 weeks worth of payroll money to do it. The extra paperwork for the forgiveness means that I don't have to then upload copies of my leases, copies of my utility bills, copies of all these other payments that could be eligible. If all I have to do is create some payroll reports that prove that I spent the money in the proper way, I think it's going to be much easier for everyone to actually document this loan forgiveness. Remember, though, you have 10 months after the 24-week period was over to actually apply for this loan, and not later than October 30th of 2021. So unless you want to have loan forgiveness this year on purpose, there's really not a lot of reason to rush, let's put it that way, but you decide. And again, remember the compensation that's eligible for forgiveness for owner employees is $20,833 for that 24-week period. It's $15,385 if you are capped at the 8-week period. So only that much compensation for you as an owner is eligible for that forgiveness calculation. Here was just a quick chart I wanted to show you that it gets more complicated depending on what type of entity you are. For payroll for a C Corp, not only was the payroll, the health insurance, the retirement contributions, and the SUTA, the state unemployment tax, were all eligible for the money that could be spent for forgiveness. If it's an S Corp, it is the salary, the retirement contributions, yes, the SUTA, but not for the health insurance. A sole proprietor had none of the above, none of the bottom. Now, the IRS argues that a sole proprietor, because they never took a deduction for those things first, we already were at their gross of all those things combined. And the same thing for a partnership, where it's basically just your self-employment taxable income that you're looking at. So what type of entity you are is going to have an effect on what expenses are eligible. But once again, if you had just payroll alone that could easily fix the problem and qualify for forgiveness, this may not be a really big issue.
We have a lot of questions popping up on this topic, so I'm wondering if this would be a good time to ask a couple of them.
Fire away.
Can you apply for partial forgiveness if you don't satisfy the 60% payroll?
Yes, and you can, the answer is yes, you can do that, and it would be the same ratio of forgiveness as you qualified. So again, if you were only at 30% of the money used for payroll, you would be eligible for 50% forgiveness. Same thing if you did not actually rehire people on purpose and you didn't qualify for any of those other exceptions. If you only hired back half of the people, you would be eligible for half of the loan forgiven. So yes, partial is, but I would say again, the importance of when I talk about Congress and what they're doing here in the opening part of the program, we have some things where it's very possible that this is not going to be an issue whatsoever. Depending on the size of the loan, it's going to be, I'm going to point out in the next couple slides here what the new, anything under $50,000 would apply for, so.
Okay, great. And is there any advantage of taking the forgiveness this year versus next year? Like what would
Well,
be?
clearly, I think, if your income is down this year, and if Congress does not act to make it tax-free, again, with that caveat, this could be the perfect year to claim the income and actually stay in a lower tax bracket. But as I pointed out in that earlier slide, if it pushed your income over and created the loss of that QBI deduction, maybe it's the bad time to do it. Because then if you're going to be out of the QBI deduction anyway, wait and take the money next year when it's going to still be forcing you out of the QBI, or you may already be out of the QBI if your income is too high from the practice. And that may be the better year to do it. So again, on a case-by-case basis, you'd have to look at that and see who really would choose to do it this year versus next.
Okay. And then there's another one here that I think is a great question. If the PPP is not forgiven until 2021, are the expenses in 2020 still deductible?
Yes. Well, again, an upcoming slide. That's the big conundrum, right? So the IRS has been completely silent on this issue. They have said those expenses are not deductible to the extent they were spent with forgiven PPP money. So if you're eligible for forgiveness and you filed an application, but it did not get approved before January 1st of 2021, is it a deduction? Is it not? I feel really certain the IRS is going to come out with more guidance on this, but for right now, I would tell you that most people are assuming that my loan has to be forgiven for those expenses not to be tax deductible. And that means that what's going to happen is if I deduct my 2020 payroll costs, and then in 2021, the loan is forgiven, I probably have income in 2021. But again, until the IRS comes out with some guidance on that, you're still guessing. And on the opposite is true. If it turned out that it was a good thing for you to actually deduct the PPP money, or take a deduction for this year and add the income back, maybe you could even voluntarily elect to report it this year on your tax return, even if you've only applied for forgiveness and you qualified. You just didn't hear back from them yet. Maybe you could elect to do it this year if it's really good tax planning for you this year. So again, I'm sure there might be some more things published on this before the year's out, but for right now, that's what we know.
Okay, great.
It's also important to say that the rent payments, if you own your own building, and when you're talking about those other expenses that were potentially tax deductible, if you own your own building, it's a related party, you can only deduct the rent to the extent that it paid mortgage interest, not any other amount of rent. So just, again, keep that in mind when you're looking at that. I think since payroll is going to be the predominant way people do this may not be an issue, but just wanted to make sure you all knew. And as we just pointed out, that whole big conundrum this year is whether, if the IRS notice says that this money is not deductible, if PPP money was used for those expenses, what are you going to do? Again, I would just tell you the IRS has issued no guidance on this yet, so stay tuned. There may be another webinar in the future, right? One of the things the SBA did do is issue a new Form 3508S. This is actually a game changer for people that had loans under $50,000. Because this does not require you to do any attestation about the FTE requirements. It's a simple one-page form, and basically all you do is you say, I promise I used the money for things that I was supposed to use the money for. That's it. And then you would still want to upload the payroll tax forms and the other things to prove that you spent the money. But under 50,000 completely eliminated the FTE situation. Again, for people that did not come back to full force, that could be a big deal for smaller loans. The form itself is really straightforward. It basically just asks you the basics, you know, name and address and that sort of thing, and you fill it out. You check a few boxes that say, yes, I promise to use the money, and you can file for forgiveness. So for smaller loans, this could be interesting. The problem is you still do have to document this. This is part of the instructions for that form. It does say they want, if you see under here, A, bank account statements, payroll reports. They could even ask for canceled checks. They can ask for anything you want. You'll need payroll tax filings and 941 forms and all the sort of things to document the fact that I promise I really did have the payroll. Even on the 3508S, the new form, they want all those things attached. But you don't have anything to fill out with respect to the questions about full-time equivalent, you know, and maybe not meeting that back. So again, you're going to have all these sort of things that you're going to have to keep. So start now to pull up payroll registers, 941 forms, all the proof that you paid those taxes. You'll be scrambling for them later when you go to file this application. And remember that for owner's compensation, they call it owner's compensation replacement, which is a Schedule C, where you don't take payroll. You may be, again, they have not offered guidance, but you'll probably be asked to see checks that were made payable to you to prove that you actually paid yourself some money out of that account. So just put OCR, or owner's compensation replacement, in the memo of a check, and if you're going to have to make copies of those for Schedule C owners. The other form is 3508EZ. The problem is this is the one that does have all the employees listed one at a time, all the average FTEs and all of their salary reductions pointed out. This is they call it the EZ form, but it's not. It's a much more detailed schedule. And so I hope we can all, either find out that this is going to be eliminated, or we can go back to the 3508S for bigger loans. I say that because the Rubio-Collins bill that's floating around the Senate right now has the language that says, in essence, all the loans under 150,000 are to be treated the same way that 3508S was. All you do is promise that you attest that I spent the money the way I really should have, send in some forms, and then it's done. So cross your fingers and hope that some form of this makes it through and the president signs something before the end of the year. That would make it much easier. And I think part of the incentive to do this, realize that these are the SBA loan stats. 87.4% of all loans were under 150,000. If Congress passes that rule, it will eliminate 4.5 million applications that the SBA would have to scrutinize. I don't know how they would ever do it without, but I think you can see the big incentive they have, because that, again, takes most of the burden off the SBA to actually get this done. We talked earlier about those IDEL grants. The problem is the grants themselves are, in fact, tax-free income. So the $1,000 per employee up to $10,000 for a business that they issued as that emergency IDEL advance money is a grant. The problem is that regardless of how big your PPP loan is, unless you had less than 10,000 and had 10 employees, which would be very difficult to do, the money that you got on the grant reduces the PPP loan forgiveness, which in essence goes back to not making it free. An example, if you had a $5,000, you have 5 employees, you received a $5,000 grant, and then got a PPP loan for $75,000. Even when you apply and you have spent all the money properly, you'll not be eligible for any more than $70,000 PPP loan forgiveness. So keep that in mind when you're looking at these applications, that it is technically a grant, but it affected the PPP loan forgiveness. At the very end here, this is completely off topic, so to speak, but I want to point out just something. Back in 2018, the Trump administration passed a whole new sweeping tax laws, and one of the things that they did was they took away the domestic production deduction. Now they added all the QBI and a lot of other things that came in, but for those of you who have an E4D or a CIRAC machine, I just want to point this out, because if you look at line 35 of your personal 1040 form for 2017, again, the plans, it's eliminated for 18, 19, 20 going forward, but you can still make a correction to your 2017 tax return right now. If you look and that line 35 is blank, consider filing an amended return, because if you have CAD/CAM technology and capability, 3D printers, things like that in your practice, you would probably qualify for this particular deduction. So you want to make sure that you've run it past your accountant to make sure that if it was overlooked, now's the time to try to make that correction. just quick takeaways. I really want to talk about this, just remind you that 2020 is really complicated this year. You can imagine all these iterations and the things we've talked about, all the options that this may have. So do not wait till April 15th to go, oh, now I should think about that, right? And again, new equipment does have this big impact for not 1 year, but 2. Apply for your HHS grant, consider these new interest rates. And if you did any construction and new improvements this year, make sure you think about turning studs and drywall into equipment deductions that are eligible for 179. Natalie, I bet you we've got a few questions we can take now.
Yes, we sure do. Let's see. I'm going to try to keep them in the same category if I can.
Okay.
Let's see. Here's one. We bought an existing business this year. Can we use Section 179 for the equipment?
Yes.
Okay, that's easy. Great. Let's see. The next one. Are you not able to use the QBI deduction if you have a negative basis? That's a question. I don't understand.
So I think so the question may be related to S corporation doctors that have a negative basis in the practice, but I would tell you that particular thing is not affected. It's a pass through to your 1040. And so in this particular case, it winds up on the 1040, but not on a corporate return. So the answer, if I'm understanding the question properly, is no. Okay. It has no effect on it. So.
Okay. Here's one regarding the HHS Provider Relief Fund. What can you use those funds for?
Again, it was the same thing that the IDEL money was to be used for. It was really intended to be a recovery from the loss of revenue throughout the shutdown period, if there was one for you, and the increased costs of practicing. The only thing you couldn't do is have the money used for the same thing as the PPP loan. In other words, if you said this particular payroll dollars were increased because of me now having to deal with more PPE, you can't say, well, I also use the HHS money for that. But I would tell you again, most people have gone through enough changes in expenses, loss of revenue, that almost any of the grant dollars are just a layup in terms of being easy to justify.
Okay, great. Regarding PPP, since it's non-taxable, how did it show up as income in your $150,000 example?
Well, the PPP money was not taxable, but the reason it showed up as income was that, remember that IRS said I cannot use the deductions that money was spent on as tax deductions. So if I had $150,000 worth of payroll for my staff, and now I can't take that as a tax deduction anymore, it's essentially the same as saying that the PPP loan created $150,000 of income. Because whether it's income or the loss of deductions, it has the same effect on my taxable bottom line.
Okay, great. What are legitimate expenses for the IDEL loan, and what happens if the loan exceeds your legitimate expenses?
Well, remember that there's not an immediate time period, first of all, on this, because many of the people that accepted IDEL loans did it to have money in the war chest. We really don't know. I mean, most states are being affected by a second wave right now. Who knows what the winter is going to bring, right? And so I think having a little extra money in the war chest is a good idea. The things that were not acceptable uses was to go out and buy a new practice, buy a new building, expand my equipment significantly for things that were not recovery related, right? Again, if I did some things that were changing my HVAC system or buying oral evacuators or things that were part of the recovery and the changes that you made to clinical protocols, those are all deductible. But you could stockpile PPE, you could buy more supplies, you could keep the money on reserve for working capital. That's acceptable. You don't need to prove that you spent all the money. Because remember, you have to pay that money back eventually. So it's not free. And so they're just wanting to make sure that you had a potential need for it. And I don't know that very few dental practices that don't have a potential need for that money as well.
Great. The PPP loan is income for 2020. How does asking for forgiveness in 2020 or 2021 make a difference?
Well, again, remember that the PPP loan, until you apply for forgiveness, is still a loan. It is required to be repaid. If you never applied for the forgiveness, you would pay that money back to the bank. And so technically, under the IRS rules, loan money is not taxable income. The problem is, again, this year, now if you applied for the SBA loan forgiveness and you received it this year, there's no doubt that that money would have to be considered taxable income under the current IRS rules. The questions and all the ambiguity becomes, well, what happens if I'm eligible for forgiveness? I actually applied, but I haven't heard back from the SBA yet. They haven't actually even formally forgiven the loan. Now is it taxable income in 2020 or 2021? I think you have a strong argument to put it in whichever year you think would suit you the best. But I mean, legally and technically, it may be 2021, but I'm just not certain that the IRS is really going to have a huge drawback to you saying, well, I just elected to claim it in the year it was received. So.
Okay. Do provider relief fund grants reduce PPP forgiveness the same as the case with the IDEL grants?
No, there's no relationship whatsoever between the HHS grants and that IDEL emergency $1,000 per employee. So no, that grant money is truly free money.
Okay. So just to clarify, because this question actually came up a couple of times. So the IDEL grant reduced PPP forgiveness, but the provider relief fund did not.
Correct.
Okay, great. Just making sure. Let's see. I'm just looking through, there's a lot of questions here, so I apologize. What is the deadline to apply for PPP forgiveness?
So you have 10 months after the end of your 24-week period, or 10 months after the 8-week period if you elected that. I don't know how many people really will, but it can't possibly be later than October 30th, because even if you had your PPP money at the very, very end of the loan process, then December 30th was the cutoff date, and then you had 10 months after that. So absolutely not later than October 30th of 2021, but 10 months after the end of the 24-week period from the day your loan started.
Okay. How about remodeling to add an operatory to be able to space out patients as a result of the pandemic? Will that qualify? Is that considered a need that the HHS funds can be utilized for, or how would you view that type of expense?
Yeah, I think the answer is probably. I'm really certain that it comes down to a question of intent. If your intent when you did that was not to, quote, expand the practice and try to accommodate more patients, your intent when you spent that money was to actually accommodate the same number of patients, but spaced out over a longer time period, or geographically space them out within the office. That was the intent when you spent the money. I feel like that's clearly a qualified cost.
Great. Is the use of funds for HHS provider relief fund forgiveness the same as PPP? It seems that it has to go towards PPE, all these acronyms.
No, actually, those provider relief grants from the HHS were basically just, again, I want to call them a recovery process. They were really trying to just help you get back some of the income that you lost and cover some of these new expenses that you have to bear. And so I would tell you that for most people, as a simple example, remember I said if you had a 2% grant and you had $1 million gross practice, you had a $20,000 grant. How many people didn't go at least $20,000 backwards in April? That if you had $1 million practice, the likelihood of you not going $20,000 backwards in that covered period, that after April 26th and before July 1st, it's really unlikely that you didn't already qualify to be able to use that grant money just to recover from loss of income. But yeah, you can use it for anything. You can use it for overhead. You can use it for loss of income. You can use it for PPE. It's not as anywhere near as restrictive as what you could spend that money on.
Okay, we do get that question a lot from our customers as it relates to PPE. So thank you for clarifying that. Mm-hmm. Someone is asking if you could just restate the QBI and its deduction. They were just a little bit late for that.
Sure. So the qualified business income deduction is 20% of earned income, but again, for specified trade or business, which a dentist is, there's income limits. So I pointed out that if your taxable income was, say, $326,000 for married and below, you're still eligible for 100%. If it gets too high, it starts to fade out and phase away this deduction. But for the most part, let's just say they'll take the easy road. I'm a Schedule C sole proprietor, and I had $100,000 of taxable income. I'm eligible for a $20,000 deduction, which just means I completely ignore that income and only pay tax on $80,000 of my business income. If I'm an S Corp, it only qualifies to the K-1 pass-through income, not my W-2. So that's why I was mentioning that it's important to balance those two things this year.
Okay. Here's an interesting question that we haven't had yet. If huge short-term capital gains were realized during the stock run-up after March, what are some ideas to offset those gains?
Well, I always remind people that there's typically a few weeds in the garden somewhere. I mean, if you go back and harvest some of these losses that you may have on other ones that didn't do as well, the rules require you to be out of a stock for 31 days if you want to buy it back. Let's say you bought a particular company that's way down and you're still convinced they're coming back. But if you sold it this year, waited 31 days and bought it back, you could still harvest that loss against that particular gain. So again, do a very thorough review of your portfolio.
Great. And someone else asking if you could review the CAD/CAM deduction again.
Yeah, so and again, for 2017 only, because again, 2018, 19, it was the rules changed in 18, but for 2017, if you had CAD/CAM equipment, look on line 35 of your 1040. Doesn't make any difference if you're incorporated or where it was, it's going to be on your 1040. Look at line 35, if that line is blank, consider filing an amended return, because if the domestic production deduction was 9% back in that day of profits from things manufactured in the US. And if you were manufacturing restorations in your office in 2017, you probably had a profit from the manufacture of something made in the US. And so it was funny that it was just overlooked on so many returns. I think a lot of other accountants just don't think about, producing things in your own office. They think of big steel and manufacturers and car manufacturers. They don't think of dentists as producing things. But when you have the ability to create something in your office like that, you are qualified potentially for the 9% deduction. So again, that could be pretty significant for many taxpayers.
Okay. And then we have a few questions regarding ownership changes as it relates to PPP loan forgiveness.
Well, the person who got the loan has to have spent the money and be eligible for forgiveness. So I guess I said, if you sold your practice, you either have to say, I did in fact spend the money and here's how it went. If you took a PPP loan and sold your practice the very next day, you're not eligible for forgiveness on that money. So you have to make sure that you're looking at that provision when you sell your practice, or look back at the time period between the time you get the loan and how can I qualify. If it was too short of a time, that might be one of those times when you want to go back and make sure you picked up, an 8-week period and add in the rent and retirement contributions and all those sort of things.
Okay, and I think we'll just take one more since we're at just over the hour now. As far as investing in equipment and technology this year, how would you recommend, if somebody is going to have a tax implication from taking advantage of some of the CARES Act funding, would you recommend that they reinvest in their practices this year so that they can potentially benefit from a write-off of that equipment?
Yes, absolutely. Because again, in that other example, if I had a $100,000 PPP loan and I do elect forgiveness this year, if I bought $100,000 worth of equipment and that offset, it completely eliminates the tax effect of having to claim that PPP loan. But if I take Section 179. So yes, I would say that it's an excellent year if you're going to do that, to make certain that you've taken advantage of new technology.
Okay, great. So there are still a lot of questions that are still coming in. What we will do is we will send out in a couple of days, everybody who registered for the webinar will get a copy of the webinar, which will include the presentation and the Q&A. We will also look to summarize the rest of the questions that have come in and then send out a summarized Q&A document for the topics that were covered today as well. Just since we do have a lot of questions still coming in, a lot of them are the same questions. So we'll go ahead and do that. We'll send this information out to everybody today. Bob, I'd just like to thank you for your time today and your expertise and your valuable insights on these topics. These are challenging times for sure, and they're changing constantly. So we may need to do it again as things continue to develop over the next several weeks, but just want to thank you very much for your time and your support today.
Sure, I appreciate the invitation, and again, I hope all the attendees found the time well spent.